Bloomberg Audio Studios. Podcasts, radio, news.
Hello, and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
And today...
Mailbag.
I didn't even say that. All right.
I said it. Don't worry about it.
Yeah.
I actually sang it.
That's what everyone wants.
Got a lot of great questions.
Thanks for sending us your questions. They really tide us over in periods where I am on vacation.
It's also nice because...
Also when Katie's on vacation.
Yeah, that's true. It's nice because I don't think we really solicited people for questions this time around.
We always solicit them.
Yeah, but not like, hey, we're recording.
Consider this a standing solicitation.
True.
Anytime you have a question, send it to us, and periodically we'll put them in a batch and think about answering them.
Yeah. So shall we start off with Mark?
Sure. Let's start off with Mark.
Mailbag. Mark asks, do you think we'll see a law firm do an IPO for itself in the next few years? I.e., will retail investors be able to trade shares in K&E or Paul Weiss in 5 years? From a business model perspective, would a public company structure even make sense? I'm sure they'd at least get the disclosures right. That's funny, Mark.
Are you sure? I worked at a law firm. I wouldn't be sure. So there are law firm IPOs, like in other countries, like I think including in the UK, you can trade shares of law firms. In the US, it has historically been prohibited because US legal ethics suggests that it's unethical for law firms to be owned by non-lawyers. This is in part for genuine ethical reasons. Like you want lawyers to have fiduciary duties only to their clients and not to their shareholders. In part for guild protectionism reasons where you want lawyers to control their own terms of employment. That's changing a little bit. You see a few states allow outside ownership of law firms. And we might see law firm IPOs in a few years. I don't know. I think of a law firm as being not a super capital intensive business where most of what a law firm is lawyers. And so on the one hand, that means that you don't need to go to public markets to raise hundreds of millions of dollars to fund AI research because you're just you're just doing deals and
law stuff, getting
paid by the deal. So there's not a lot of long-term investment that only pays off years later. That's not entirely true, right? And I've written a little bit about the litigation finance market. And one thing that litigation finance is law firms that take on incredibly complicated, very long-term consumer class actions where they invest a lot of resources over years and don't get paid. And then 5 years later, they win some massive verdict and get paid $1 billion, right? That sort of investment is a little bit hard to do when you're just some lawyers who need to make a living. And so they get outside investors for that. And it's not share ownership, right? It's a sort of special financing vehicle. But you could imagine doing that in IPO form where you just have a publicly traded law firm that can make long-term investments. And also just there's some level of long-term investments that you would make if acquiring a new team that does some kind of work, right? And you're hoping for it to pay off in the long term. The other problem with law firms is because they are just people, they can leave, right?
Yeah.
It'd be funny to be a law firm and go public and then sell your shares and collect money and then go leave and start another law firm and do it again, right? There's not a ton of stuff there other than the lawyers, right? There's some franchise value in the name, but probably less so than there is at a big investment bank. And you don't have as much capital intensive business. So if you just leave, you can capture most of the value that you previously sold to investors. And you see that where law firms law firms are pretty fragile businesses. And if a law firm runs into trouble, it's very easy for it to break up because, if some law firm, its main business stops working and it's not making money, the people who the M&A team who are really good can just go somewhere else. And it's not that jarring for them to leave. They don't lose a lot of franchise value. So it's a little bit of a fragile business to take public, but people do it elsewhere. So
it kind of reminds me of publicly listed hedge funds. There's a lot of key man risk there.
Yeah, right. There's a lot of key man risk. And it's the same thing where the assets walk out the door or whatever. But hedge funds are still better because the hedge fund has long-term contractual relationships with its investors. Now there might be like key man provisions in that, but like law firms don't really have that, right? Like law firms like do things by engagements most of the time, like often don't have like long-term contracts with their customers. And so, anyone can leave and take the clients with them.
Yeah. Well, I wish that there were publicly listed law firms just because I think it would be interesting to see how they trade and how they move as a group. Like,
yeah, there'd be a lot of like information in law firm stock prices like now as like law firms are under attack and so forth. But yeah, I don't know that it's a great idea for the law firms.
Well, it was a great question, Mark.
Thanks, Mark.
Yeah.
Also from Mark, I assume the same Mark. For Katie, would you buy a cyber horse? Kawasaki just announced one. Google Kawasaki Corleo, and it looks absolutely wild.
I love that all your questions are real. All my questions are
all your questions
horses.
Are horse related.
I do appreciate the question, Mark. I can tell that you're not an equestrian. Not to sound,
neither a lawyer nor an equestrian.
Not to sound too much like a horse girl. It does look awesome. I did see the video. It looks like a lot of fun, but having a horse is about much more than just riding it. It's about your relationship with your horse, and I actually really value that. My childhood pony is named Batman. He's still with us, but he is very much retired. He's only a couple years younger than I am. I haven't been able to ride him since like 2020. He's been out of commission. And I bought the horse that I currently ride, whose name is Gus. I bought him, as a 3-year-old in the summer of 2021. But there was a solid year there where I was just driving out to the barn to hang out with Batman, literally just hang out with him, which is a lot of driving and a lot of time, but it's a relationship. So I would not buy a cyber horse. I like my...
You wouldn't drive out to the barn to hang out with your Kawasaki cyber horse?
No, I'd just put that in the garage.
Would you buy the cyber horse for like riding when you can't get to the barn?
No.
Like an exercise bike when you can't get outside?
I don't think so. No? I don't really think so. It's not like like if I go for a long time without horseback riding, obviously I miss it because it's fun. But it's like when
you don't need like the horse treadmill in your apartment.
Like if I'm on vacation with my parents, for example, my parents
pull a horse out of the suitcase.
But like people go on rides, like trail rides and stuff. I like having, one dance partner. I don't really crave to ride any horse.
You're not going to cheat on your horse with a robot horse.
It's weird. It's like it's a long-term relationship. Batman has been in my life since I was 11, and I like to just have one horse, one relationship at a time. So I probably wouldn't buy a cyber horse. But thank you for the question, Mark. Anyway, moving swiftly along, I feel like I shared part of my soul there. Mailbag. This one comes from Will. He says, love the podcast. I have a question about private credit moving to marketplaces. It strikes me that the underlying companies with this type of debt, like private equity portfolio companies, have little interest in their debt trading. I worked at a PE fund and now work at a portfolio company. And a lot of the value from lenders is that you are a repeat client with a relationship in case you want to change the agreement, e.g., or example, do acquisitions, or are under duress. We have debt in our debt documents that debt holders are not allowed to transfer their debt without our permission, which I imagine is a pretty standard term. Given the negotiating leverage, hot demand for lenders to issue more private credit, why would a firm be okay with their debt trading? With these dynamics, it seems pretty unlikely that private credit would materially move to a marketplace.
So I think that's absolutely right, that like a lot of the value proposition of private credit to borrowers is you will have a long-term relationship with your lenders who will be nice and won't sell your debt to like distressed debt vultures. I'm not sure that that would prevent a marketplace from developing. So first of all, one thing we've seen is like quasi-marketplaces for LP stakes in private credit funds, which is a different thing, right? Like instead of actually your debt trading, like you're still facing, as a borrower, you're still facing the same private credit fund, but like the ultimate owners of that fund can shift a little bit. So that's not quite the same thing as a private credit marketplace, but it does like give the LPs like some ability to get liquidity and some ability to get like marks. But like, I don't know, even within like the private credit like loans themselves actually trading. You know, Apollo is setting up a trading desk, right?
Yeah.
I think that one thing that is possible is to have some sort of marketplace where you have like the borrowers have some ability to limit who can buy their bonds, right? And you see a little bit of this in like the broadly syndicated loan market where like there's approved lists of who can buy the loans. But you could have a thing where, you know, the marketplace says, you know, each borrower can specify who's allowed to buy their loans or like can specify who's not allowed to buy their loans so like they don't get bad distressed vultures. But one thing is that like private credit is kind of new and hasn't seen like distress cycles, and like some of the talk about like private credit is nicer to companies that run into distress. Like you can imagine a world where there's like a broad downturn and that stops being true because it sort of stops being true for everyone at once. And similarly, you can imagine a world where like, you know, private credit funds need to sell and they all need to sell. And so there's like some amount of leverage for them to be like, look, we got to, you know, have ability to trade and where some more trading springs up. But I agree that like in a dynamic where there's a real huge demand for paper and the borrowers have a lot of leverage, it does seem hard to be like, we're going to have total free tradability where anyone can buy your loans because like that is the thing that the borrowers don't want.
Yeah. It's interesting. I mean, Apollo is, you know, on one end of the spectrum, and then you have like Blue Owl on maybe the opposite end because they think private credit should stay private. They're not setting up a marketplace. I believe they're on the record saying that.
Yeah, I think everyone will talk about relationships are really important and like being a buy and hold investor is really important. But, you know, at the same time, Apollo is like, you know, getting this to retail investors is really important because
we want this in your 401k.
Yeah. And like ultimately the pitch of that has to be we can get better rates if there's more liquidity and more, like a broader audience for it, right? Like at some level, if you go to a borrower and you say, in exchange for not having a warm personal relationship with you for the rest of time, we'll charge you 50 basis points less. Some borrowers will say yes to that, right?
Yeah. I like that Will brought his own personal experience to the question as well. Great question, Will. Should we move along to Max? Max. Mailbag. Regarding Matt's story on equity funding costs, increasing costs of S&P futures, this seems like a great place for ... an ETF, ? 2 exclamation points. I think the ETFs that sell zero-day options are very fun, and selling S&P futures, then collecting the spreads does seem to rhyme with this in some way. Could an ETF do this while still being liquid and tradable? Does this already exist in the form of covered call ETFs, or is selling futures different in some way? P.S. I'm a molecular biologist, not a finance person, so sorry if this question is totally obvious, 2 exclamation points. That was charming, Max.
So I love this. So we talked on the podcast last week about the basis trade.
Yeah.
This is the basis trade for S&P 500 futures, right? Like this is the trade here is that people want to buy S&P 500 futures to basically get like levered exposure to the S&P. And it is hard for them to do that because nobody or banks don't want to use their balance sheet to buy the S&P and sell futures against it, right? Like, so someone needs to provide the funding to buy the S&P, buy the actual stocks, and then sell the futures to people who want to buy the futures. Who should provide that? Well, one answer is money market funds. Basically, like that trade, it's not a stock trade. It's just like a cash trade. It's like lending balance sheet to provide people with access to stocks. So you buy stocks, you sell stock futures, you have no risk. You're just like providing funding. And if, as has been the case, that funding is expensive because like banks don't want to do it and there's a lot of demand for these futures, then you can get paid a lot for providing that funding. And the reason it's like no one wants to do it and it's expensive is just kind of a weird trade, right? Like if you are a money market fund, someone can come to you and be like, look, what you should do is you should buy the S&P and sell S&P futures and you'll get paid a very high cash return for that and you can get it anytime you want. It's like a money market investment. You'd say, no, it's not a money market investment. I'm not allowed to buy stocks. I'm not allowed to sell futures. Like none of this is allowed. And so money market funds don't do it. And, you know, I wrote about this because like there was a story about like some like long only fund managers who have like some ability to be pretty tactical are like, yeah, we're doing that. Instead of buying treasury bills or doing repo or whatever, we are buying the S&P and selling futures and we're getting paid, 10% instead of 4%. But not a lot are doing that. And so the question here is, why not an ETF? And it reminds me of, do you remember the ETF called BOX? BOXX?
How could I forget?
So this is the same thing, right? BOX is like a crazy trade where it's like they like buy and sell options to get cash returns and have no equity risk. And also they think get really good tax treatment, although that is highly debated. But this is the same thing, right? It's like BOX is like basically there is demand for lending in the options market. And we are going to be the lender into the options market. We're not buying options, selling options. We're not doing any options trades. I mean, we are, but like not to do options trades. We're doing them just to be a lender into the options market because the options market will pay more for cash than like treasury repo markets will. And this is the same thing. It's like the S&P 500 futures market right now will pay for cash. So someone should set up a ETF that will provide that cash. I think the reason there's not an ETF it's probably one launching next week, but like, I think the reason there's not an ETF is like, it is not at all clear that this is a permanent trade, right? Like this can go away at any time. And so it's a little weird to set up a ETF that will do this trade for years if like, next week.
A flash in the pan.
Yeah. Like it's a little tempting to be like, there should be a weird cash trade ETF. Like you could have an ETF that's like, we're a money market ETF, but like we're not constrained to regular money market instruments. We can do anything that's like a short-term cash investment. Yeah. And like when S&P 500 futures basis is wide, we'll do that trade. And like when something else works, we'll do something else.
Well, I mean, I hear what you're saying that, it's hard to know if this is permanent. To that point, I'm really surprised that there isn't a treasury basis trade ETF. Not that because I think it should exist. Why? Because there's so many opportunistic filers.
But that trade is, we borrow 100 times our net asset value to buy treasuries. You can't do that in an ETF.
There's some issuers that I talk to often. I wouldn't put it past them.
No, I would put it past them. Like, you're not allowed to do that.
I'll see.
I feel like you're foreshadowing an actual basis trade ETF.
Max, great question. Good luck with the biology. Mailbag. All right, Sal. Sal has a question. Sal asks, what is the value of the option to declare personal bankruptcy? And how would you monetize it? Could an investor recruit a bunch of 18-year-olds to take levered risks?
I feel like the option value is very low because you can't get that much money when you're 18. The question is, in general, if you borrow money, you have to pay it back. And so if you borrow money to buy lottery tickets and you lose all the money, then you're in trouble because you have to pay back all the money and your lottery tickets didn't pan out. But if you declare bankruptcy, then you don't have to pay the money back. This is the theory, right? You effectively like can structure your financial life like a call option where like if everything works out, you get all the upside. And if it doesn't work out, you don't get any of the downside because you declare bankruptcy and move on. Now, there are several problems with this. One is like declaring bankruptcy is in some ways a downside.
Right, right.
You don't necessarily want to declare bankruptcy. And the reason that Sal asks about 18-year-olds is that like if you're 46 and have a house, you probably don't want to declare bankruptcy. You probably get to keep your house, but that's not legal advice. But like, your life will get worse if you declare personal bankruptcy. Whereas if you're 18, your life may not get significantly worse if you declare personal bankruptcy. But that's why they won't lend you money. Like you can only borrow so much money when you're 18 because they know that this option exists. And the one huge exception to that is student loans because they're not dischargeable in bankruptcy. Right? Huh. Yeah. It's like you can borrow hundreds of thousands of dollars as an 18-year-old to go to college, not because that's a particularly good credit risk, but because like you're not allowed to get rid of that debt.
Yikes.
Yeah. And then the other part of the question is, could an investor recruit a bunch of 18-year-olds to take levered risks? Like even if you could do that and like you structured a deal with them, like someone would find you. They'd be like, this wasn't really an 18-year-old borrowing this money. This was you, the investor, borrowing the money. And they'd like, try to look through it and get you to pay it back. So I think that it is pretty hard to monetize the option to declare personal bankruptcy. But one reason I wanted to ask this question on the show is I'm sure we will get emails from people who are like, this is how I monetize the option to declare personal bankruptcy.
It's beautiful. And we can talk about that in our next Mailbag episode, possibly.
Or even in the next regular episode.
That's true. That's true. The possibilities are limitless.
Mailbag.
Mailbag.
Here's a question from John on the podcast some time ago. Katie quipped that she might name a kid Xanadu someday. I feel like Katie would be more likely to name kids, hers or other people's, after ETF tickers. What ETF tickers would be the best children's names? What about horses' names? I don't know that we have an answer to this question, but it was a funny question.
John, I'm not sure if I like the way your brain works, but...
What do we know about Katie? Horses, ETFs.
Yeah, so no, I don't think I would. No one's asking me to name their children. I actually have a lot of children's names that I love.
Okay, so they don't have to be ETFs, just...
John Corrado is a name that I would love to unleash at some point. I loved it. I love the name Corrado so much. It's like an old Italian name made famous by The Sopranos. I feel like you can't name just a kid your first name Corrado anymore. You don't really hear it. But if you put John in front of it, then he becomes JC, John Corrado. I love that.
This is like a really well thought out answer.
I think about this a lot. And then I have a lot of ladies' names that I like. I guess girls' names. In terms of ETF tickers, there are some fun ETF tickers out there. None that I would name a child or a horse after. I'm sure there's a Gus ticker out there, and if not, maybe there should be. I love the name Gus.
For a horse.
For a horse. For a kid, too, but it'd be weird to name your child after your horse, probably.
Yeah.
I feel like certain husbands might take issue with that.
Plus, there'd be like the uncertainty when you referred to Gus.
Yeah, that's true. At first, I thought this question was, what is an ETF ticker that you think should exist, which is not this question.
No.
But I have an answer to the question that wasn't asked.
To the question you imagined. Mailbag.
There's all these, not all these, but there's been a lot of interest in Texas lately from the ETF community. BlackRock filed for a Texas equity ETF a few weeks back, and it wasn't listed with a ticker. The ticker y'all is already taken. I think YHAW would be cute. Like yeehaw. So Larry Fink, friend of the show, if you're listening, there you have it. Mailbag. Neil, rounding us out. Listening to Friday's Money Stuff got me to wondering, why not just split the difference and put a bunch of different BDCs into an ETF? All the exposure to private credit and the BDC assets, all the shiny exchange-traded wrapper that the kids today enjoy. Something for Matt, something for Katie. Neil, rather.
Listeners know us so well.
Neil, I like how your brain works.
This definitely exists. There's 1 minute of Googling found me BizD, which is the Van Eck BDC income ETF, which is in fact an ETF of BDCs. For all I know, there's millions of them. Yeah. I have said that BDCs are the publicly traded form of private credit, and so you don't need the convolutions of putting private credit into an ETF because you can just have a BDC. There's like some limits on that. Like BDCs are not like the full spectrum of private credit, right? They're like sort of designed for small and medium enterprises.
Yeah.
So it's like not exactly the same as saying every private credit fund could be wrapped in public form as a BDC. But many can and are, and there are BDCs for a lot of the big private credit funds, and you can ETF them if you want.
Yeah.
Should I say? No, never. I was going to say, have I said what a BDC is? It doesn't matter.
Why don't you say it again?
Anyone who's listened this far.
That's true.
What's an ETF?
On minute 37 of the Mailbag episode for the Money Stuff podcast.
We're on like year...
Oh my goodness.
Yeah, it's like the anniversary. Happy anniversary to...
Happy anniversary. It was actually last week's episode,
right.
Which we recorded today.
Yeah, we're recording them simultaneously, so we can just pass that back in. Maybe.
Man, April 12th? Wow.
Yeah, between last week's episode and this week's episode, Money Stuff, the podcast, turned 1.
Yeah, it is crazy that it's been that long.
Yeah. Now it's over.
You've listened to the last episode.
We won a year.
Have a good life.
We won the bet. Now it's over. And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff podcast is produced by Anna Mazarakis and Moses Andam.
Our theme music was composed by Blake Maples.
Brendan Francis Noonan is our executive producer.
And Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff podcast. We'll be back next week with more stuff.